An extraordinary global economy will require extraordinary agility. Policymakers need to adjust their approaches, including through preemptive negotiation with the incoming US administration. The global economy in 2025 is shaping up to be anything but ordinary. Already, shaky confidence in an outlook of solid growth and lower inflation has given way to anticipation of non-notably wide range of potential outcomes. The question is not whether the US will continue to outperform most other countries, it will. It is more about the levels of divergence in growth and inflation and the degrees of disruption in global economic and financial architecture. The implications extend well beyond short-term economic well-being. We are currently seeing a rather unusual combination of US economic exceptionalism and deeper crack in the Western-dominated global architecture that has served the US well. It is an unstable mix that, derailed by its growing internal contradiction, will lead to much greater global fragmentation in trade, technology, and payment system, together with slower growth and higher inflation in the US and elsewhere. Alternatively, if timely policy action are taken, the world could stabilize in a form of globalization light, negotiated between countries rather than fragmentation. This could enable growth to develop deeper roots, anchor price stability, and counter systemic malfunction. Already, the global economy enters 2025 with considerable growth and financial market divergence. Last month, the IMF improved its 2024 growth rate for the US to 2.8%, a level that is likely to be up again. In the Eurozone, growth languishes at just 0.8%, and in the emerging world, economies are slowing, with China struggling to deliver its already lowered forecast of 4.8%. Even India, the star performer, may see its 7% projected growth at risk. Meanwhile, the S&P 500 index has gained 27% year-to-date, significantly outperforming markets in Europe, China, and India. There is little on the policy front to suggest a change in this international picture. French and German economic policy making is hindered by considerable political uncertainty. Amid some concern that China is facing a deepening Japanification of its economy, Beijing is struggling to reconcile the reorientation of its growth strategy with short-term pressure for old-style stimulus measures. At the same time, the last mile of work by major central banks to achieve low and stable inflation is proving tricky, undermined by hesitancy to pivot decisively from their overreacting mode of excessive data dependence to set policy. The lack of strategic, forward-looking approach has led the Federal Reserve in particular to a series of signaling flip-flops that fuel bond market volatility. With the absence of credible forward policy guidance, there is now a growing debate on whether the Fed should continue to cut rates, skip, or pause in December, let alone what comes after that. All of this is before the changes coming with the new US administration. They are particularly complex for investors to analyze as potential shift in US trade, migration, and fiscal policy interact with a range of response in corporate pricing, demand and supply elasticity, game theory, and statecraft. There's also a question of how economic pressure will spur secular changes, in particular the international reserve diversification away from the dollar and growing interest in alternative non-dollar payment system. This is at the source of Trump's weekend warning to BRICS economy on dollar. We require a commitment from these countries that they will neither create a new BRICS currency nor back any other currency to replace the mighty US dollar, or they will face 100% tariffs and should expect to say goodbye to selling into the wonderful US economy. The question over such an uncertain outlook can only be comfortably answered if you have confidence in policymakers' ability to understand this unusual dynamic and adjust accordingly, including through reasonable preemptive negotiation with the incoming US administration, consistent with longer-term alignment and shared interests. This is visible for most countries with a notable exception of China. The longer they delay, the greater obstacle of existing drivers of growth and financial stability, and the harder it will be to unleash exciting engines of future prosperity such as breakthroughs in artificial intelligence and life science. Political leadership, policy agility, and reasonable compromises can create a pathway to a brighter medium-term outlook.